part of what I said is based on one or two experiences where we've been asked to raise capital for, and we've said no, for a couple of groups that are funding development, and have principally been set up to provide developers with debt, and it's just quite worrying. You know, maybe I'm overreacting.
Worrying in what sense?
Well, because in some of the product that they're going to produce, so this allows more developers to produce more product. If it's the right product in the right place, that's fine. But if through competition they get forced to the edges of markets, the less prime locations, and if the tide then goes out, like it did in 2007, that caused some of the issues that we had to deal with for 5 or 6 years. So I just feel that there are some instances. I think London's probably the epicenter of my worries, because there's an awful lot of resi being built here based off demand that might not be sustainable.
Do you think demand is not going to be sustainable in London for housing?
Yeah, well, look, most that's being created is for the very top end.
Well, yeah, that's the pitching in the market segment, which I think is
I don't know whether Johnny's got any stats on this still, but the majority of that is being bought by non-UK investors.
Yeah.
Now, if that demand dries up, who then buys it?
That's a global phenomenon, that the resi developers, once they have access to cash, actually pitch too high, because that's where the margins are. That's maybe where land prices actually force you to actually position your product. As I said, I've just been to India, and they have a real issue with hundreds of thousands of units in the core markets, which have been built to a demand which is no longer there. Although affordable housing would be quite a good idea, actually, with 500 million people below the poverty line.
And I don't have the stats, Will, but I mean, I think you'd be pleasantly surprised by how much UK money is going into London residential. Certainly from our, guys, that, yes, we're selling to, Asia and global money. But as you look at, London growing, and you've got the growth of the Thames corridor, you've got the growth of Docklands, and, there's a huge amount more coming up. Our own information is that there's a lot of UK money going into that. I mean, not at the very top end, but again, that market has definitely weakened.
For investment or for occupation?
Both.
Okay.
But I mean, it's just an observation. It's I can give you some.
The thing that kind of sparked my concern, but both some of the things we've been asked to do, but also beginning to hear that some of the secondary market sales in residential, in some of the decent schemes in London, were actually undercutting the primary market pricing, and that says that the person that either want to capitalise on their investment, and they've made a bet 3 years ago and they want to take the capital off the table, and they're willing to take a discount on market price. But if too many people start doing that, then the primary price gets affected.
Is this affecting your buy-to-let portfolio?
If only I had one to be affected.
But if I'm reading it right, your other slight concern in terms of the debt funds was that although the banking sector has been much more heavily regulated, that the debt funds at the moment are not in the same position, and so if more capital is raised by them, they've then got to allocate it, and if they're then moving down the same route that the banks did in 2007, then you begin to get more problems.
I take David's point that in many of those vehicles there will be caps on leverage levels, and hopefully investors will have forced the managers that they've invested with to behave themselves. But there's a temptation, if the core space or the senior debt space is very full, and broadens out. In 2012 we decided not to do a debt fund at Global Investors, because we could see the bit that we wanted to get into was going to be massively populated by the time we got our act together, raised the money and put it in place, and the margins would have been reduced dramatically, and that's in the end what happened. And there are 2 or 3 players like Paramerica, like AXA, in the senior debt space that are a long way ahead. And the debt funds behind them, and there are some very good debt funds out there, don't get me wrong, but I think there are some managers that raised equity to put in the debt market that are now probably struggling on returns and probably struggling on deployment, and the temptation is to take more risk.
I think I think there is that lag as well, because I think some of the debt funds that by the time they'd established found it hard to achieve the same returns as they were originally contemplating, simply because the banks were lending more and more and it became more competitive. I think there are some debt funds which actually, like the resi debt funds, which in some ways they are taking just real estate risk, and that in our experience seems to be much more market targeted at sort of high net worths and syndication who are looking for accruing return but rolling up as a pick against the value on exit. But from a macro point of view, I mean, the shadow banking issue is relevant, but there is a difference between debt funds and banks in that there's no potential for a maturity mismatch, i.e. the debt funds have raised their cash, whereas the bank's out there in the market raising money on the capital markets if it's not funding it through deposits, and has its own sort of liability matching to manage. So that sort of element of the sort of potential for contagion from shadow banking doesn't apply so much for debt funds.
Okay, good.